One of the problems with recruiting for investment banking is not the knowledge or skills you acquire, but the access to talk with real investment bankers to put your best foot forward. Our sponsor, WSO Academy, can provide those connections with 60 head mentors who are finance professionals at top firms like Goldman, Centerview, and JP Morgan. Imagine being able to get on the phone within 24 hours with one of the Academy's 1,300 mentors right before a critical interview. Get on the waitlist for WSO Academy today by clicking the link in the show notes or by visiting wallstreetoasis.com/academy. All right. This is the Investment Banking Insights podcast. My name is Alex Mason and I am your host. Thank you so much for joining me. And this is the show where we are learning the ins and outs of investment banking concepts, both the technical side and a few episodes on the non-technical side, but we have transitioned to studying accounting now. And yes, so let's go ahead and get into the balance sheet today. Now, there are 3 financial statements that you'll want to understand as an investment banker. There is the balance sheet, the income statements, and the cash flow statement. And they all serve different functions and they all work together in different ways. But today we're going to be focusing on the balance sheet. What is the balance sheet? Well, if you listen to the last episode, you learned with me the basic equation of accounting, which is, quick recap, assets equals liabilities plus shareholders' equity. Now, the balance sheet basically lists out those assets, those liabilities, and the equity. Assets are everything that you've got plus the right you have to collect future cash. So let's focus on that part right now. Assets are everything that you've got plus the right that you have to collect future cash. So let's say that I own a business. And what are my assets? Well, I have cash in the bank. So that's an asset. And then let's say that I have the right to receive payment from a customer who's ordered something, but they haven't actually paid me yet because they have 30 days to pay me on credit. Well, even though I haven't collected the cash from them yet, I'm still counting it as an asset because I have the right to collect it from them. So that can be counted as an asset too. It's not necessarily just things that you own right now in this exact moment. So that's an important distinction. And I want to talk to you about the other aspects of assets and how we can kind of categorize them. And remember, the asset section of the balance sheet is this top half of the balance sheet. And that's what we're focusing on right now. So the way that we can think about assets is really at 3 different levels. And the way that we're focusing on them is based on liquidity. Now, let me define liquidity for you if you're not familiar with that term. Liquidity, it's kind of a cool word, right? It sounds like liquid, and that makes me think of a flowing river or a nice cold glass of water. Basically, what liquidity is you have access to that asset. So think about the difference between cash in a checking account versus cash under your mattress. Now, I don't know about you, but I don't have cash under my mattress. But if I did, I would have that money right away. That's super liquid. I have access to it immediately because I physically have it in my home. Whereas cash in a bank, maybe I have to go to an ATM or I have to walk into a bank branch and actually withdraw that cash. But it's still pretty much liquid. I can get it when I need it. There are ATMs all over the place and I can get cash pretty much at any time available, especially if I live in a major city. Now, compare that to something like a car. Now, we all know that a car is worth something, right? It has value, but I can't just convert that into cash immediately. I have to find someone who's willing to pay me for it. And so it's not quite as liquid, we would say, as something like a pile of cash because yes, it's worth something. You can convert it into cash, something that you can spend right away, but it might take some time. And then you can keep going further down the spectrum. Like you can think about a house, or you can think about an entire business, or you can think about some other kind of asset like rare jewelry or some kind of collectible. We have things that are worth something, but in order to actually get the money for it, it might take some time to find a buyer and match a buyer and seller. So that's this concept of liquidity. Turning our attention back to the balance sheet now, this is one of the categories of assets. These are considered liquid assets, things that the corporation can just immediately use for cash to buy things if they want right now. So cash is the most liquid asset, but usually corporations don't just keep cash itself on their balance sheet. Sometimes they do, but usually they buy bonds. And if you're unfamiliar with what a bond is basically a loan. And corporations will buy these loans and then collect interest. But these are usually very, very short term bonds, meaning that they have lower risk to them. So they're making a little bit of interest on that money instead of just letting it sit there in the bank account. I won't delve deeper into the details on that, but just understand that cash is the most liquid asset that a corporation can have. And then the other category of assets are productive assets. These are the things that are actually working to help the business run. So think about things like machinery or equipment, or maybe there's an office space that's valuable that people at the company work at and they need it to do a certain type of work. That's a kind of productive asset that you'll see on the balance sheet. And then the third type of asset you'll see on the balance sheet is an asset for sale. These are things that are waiting to be sold, inventory waiting to be sold. So imagine if you're the Campbell Soup Company and you've got all these cans of soup ready in the warehouse to be distributed to grocery stores all over the country, that's an asset waiting to be sold. So that's another type of asset. So those are the three categories that you'll want to be aware of. Another thing you'll want to be aware of on the asset side of the balance sheet is this term called accounts receivable. Accounts receivable. So just breaking this down, we're talking about accounts, right? And then receivable, something that we get. So what does that mean? It just means that somebody owes the company money, but it hasn't been paid yet. Recall a few minutes ago, I talked about an asset is something you have plus the right that you have to collect future cash. Well, this is that right to collect the future cash. That's what accounts receivable is. So if someone comes to your company and they buy something, but they haven't actually paid for it yet, but they've ordered it, then we can put the value of that order in our accounts receivable. So, yeah, we haven't gotten it yet, but we know we're going to get it. And so we're going to count that as cash money that goes to the asset side of the balance sheet. So that's what an accounts receivable is. And then I also want to share one other part of the asset side of the balance sheet that's important to know. And this is called prepaid expenses. So if you have some kind of major expense that is coming up and you prepay it, that can be considered an asset because you've already done it. You already essentially have defrayed that expense ahead of time. So that's another thing that you might see pop up on the asset side of a balance sheet. And that's all I have for you now. Next episode, we're going to be talking about a couple other things on the balance sheet and talk about a couple important concepts like working assets and depreciation. So join me next time for a discussion of those topics. This has been Investment Banking Insights. My name is Alex Mason and I am your host, and I'll see you next time.